Hello, and welcome to a special edition of TFN's Market Insights. I'm Sarah Nunnally. BHP cheerfully submitted a takeover offer for Rio Tinto on Monday, November 12th. It's worth $174 billion. You'd think that'd be like dangling a crown in front of a homecoming queen candidate, right? Not so. Rio Tinto rejected the offer. Turns out, Rio thinks that crown's a cheap piece of tin, and how dare BHP snub the world's largest supplier of industrial metals and the world's second largest supplier of iron ore. Now, like a spurned lover, Rio Tinto is refusing to talk to BHP. It doesn't matter that BHP's offer constituted a 25% premium to Rio Tinto's price at the time, and apparently it doesn't matter that BHP offered an additional $30 billion in the form of a share buyback. Rio Tinto's not going for cheap, and the number one factor that could influence its decision is China. In fact, it's been rumored that China Development Bank has started buying up shares in Rio Tinto so that it would have the power to block a merger between the two largest Australian mining companies. China Development Bank has, of course, denied taking a stake in Rio Tinto, but if it's true, it will be the first time ever a Chinese state-backed entity has taken a direct stake in a global mining firm, at least according to Forbes and Britain's Daily Telegraph. Here's why China's so scared. The merged companies would control about 40% of the world's iron ore sales, and China's booming industrial growth already accounts for about 50% of the world's production. BHP would have unprecedented power over the price of iron ore. Looks like BHP's got a tougher row to hoe than it expected, but let's assume for a moment that Rio does eventually agree to this merger. What does that mean for the mining industry and resource companies as a group? Some analysts, and I'm not going to name names here, would remind investors that the two previous huge mergers signaled the top of the tech boom. I'm talking about the Vodafone-Mannesmann merger and the Time Warner-AOL merger. This is comparing apples and oranges, folks. The two sectors are very completely different. It's like saying that bleaching your red sweater has the same effect as bleaching your white button-down shirt. And commodities as a whole have so many different factors influencing it that a possible merger between two mining companies can scarcely be blamed for a crash in corn prices. Truly, if you believe that a BHP-Rio merger signals the end of the commodities boom, I've got the deed to the Brooklyn Bridge up on eBay. Care to put in a bid? For TFN Markets Insights, I'm Sarah Nunnally.